Welcome back to the Daily Crypto Deep Dive. This week is far more important than it looks on the surface, because it's not about a single pump or a headline-driven move. It's about whether the market can hold strength after showing it. That's the difference between a relief rally and the early stages of a real trend. Right now, Bitcoin is holding the mid-$90,000 instead of snapping back lower. Ethereum has broken above $3,300 and, crucially, hasn't immediately faded. Altcoins are participating, but not in a reckless, everything goes up kind of way. And sentiment, while improving, hasn't tipped into euphoria. According to multiple sentiment trackers, retail enthusiasm is still muted compared to previous peaks, which matters because markets usually top when optimism becomes universal, not when people are still skeptical. Several analysts have pointed out that structurally, this move already looks different from the failed rallies we've seen over the past year. Funding rates across major exchanges have remained relatively contained, meaning traders aren't piling into excessive leverage. Open interest has risen alongside price, but not explosively, a sign that positioning is building gradually, rather than flipping into mania. On-chain analyst Willy Woo has noted that this kind of price action, steady gains with controlled leverage, often appears early in sustainable uptrends rather than at the end. At the same time, exchange balances continue to trend lower, indicating that more Bitcoin is being moved into longer-term custody instead of sitting on exchanges ready to be sold. That doesn't guarantee higher prices, but it does reduce immediate sell pressure. Another reason analysts are treating this week as a genuine test rather than a blow-off is the way key technical levels are being respected, not ignored. Bitcoin isn't just drifting higher. It's reclaiming former resistance zones and then holding them. The move through the low $90,000 region was important because that level had rejected price multiple times before. When markets break through a level like that and then fail to collapse back below it, it signals that supply at that level has been absorbed. Technical analysts often describe this as a regime shift, where sellers who once dominated a price area are no longer in control. Ethereum is showing a similar pattern. Breaking above $3,300 wasn't the story. The story was that it stayed there. Ethereum is now trading above its medium-term moving averages, and more importantly, its pullbacks are shallower than its advances. That's classic trend behavior. Several analysts have pointed out that Ethereum's relative strength index on higher time frames remains elevated but not extreme, suggesting momentum without exhaustion. In past cycle tops, these indicators tended to spike aggressively before rolling over. That's not what we're seeing here. Derivatives data adds another layer of confirmation. Funding rates across major exchanges remain neutral to slightly positive, which tells us traders aren't overcrowding the long side yet. Open interest has increased, but it's rising with price rather than racing ahead of it. When open interest explodes while price stalls, that's often a sign of leveraged speculation. Right now, the relationship looks balanced. Add to that the fact that realized profits remain well below historical peak levels, and you get a market that's advancing without widespread profit-taking pressure. That doesn't mean price can't pull back. It can. But it does mean the rally isn't being driven by late emotional positioning. So the market has done the first, and often hardest, part of the job. It's moved higher without blowing itself up. But continuation is where rallies either prove themselves or fail, and this is why this week matters. The first and most important test is how Bitcoin behaves on pullbacks. In weak markets, every dip accelerates. Support levels fail quickly, bids disappear, and confidence evaporates. In stronger markets, pullbacks are shallow and controlled. Right now, dips of a couple of $1,000s are being absorbed, not cascaded. Analysts like Glassnode's team have highlighted that realized profit-taking remains moderate relative to prior cycle peaks, suggesting holders aren't rushing for the exits. Technically, Bitcoin holding above its short-term moving averages and staying above the former resistance zone around the low $90,000 is constructive. A clean break back below that area with speed and volume would be a warning sign. But so far, the structure is intact. The second test is Ethereum's relative strength, which matters more than many people give it credit for. Bitcoin can grind higher on its own, but when Ethereum outperforms and holds those gains, it usually signals broader risk appetite returning. Right now, Ethereum has reclaimed levels above $3,300 and is holding above its 50-day and 100-day moving averages. Analysts at Standard Chartered have pointed out that Ethereum tends to lag early in rallies and then lead once confidence builds, particularly when DeFi and on-chain activity begin to pick up. If Ethereum maintains strength relative to Bitcoin this week, it reinforces the bull case. A sharp loss of relative strength, on the other hand, would suggest risk appetite is still fragile. Third, we need to look at altcoin behavior, selectively, not emotionally. Healthy markets rotate capital into liquid, established altcoins first. That's what we're seeing now with names like Ethereum, Sol, Link, ADA, and even Doge seeing renewed interest. On-chain data from Sentiment and others shows whale accumulation in several of these assets, not just speculative spikes in thin liquidity. What would be concerning is a sudden explosion of illiquid, low-cap tokens purely on hype. That often marks late-stage behavior. Right now, rotation looks measured. Analysts like Benjamin Cowan have long argued that sustainable altcoin moves follow Bitcoin and Ethereum strength, not precede it, and that pattern is still holding. Volume and participation are another key piece of the puzzle. Strong trends don't need blow-off volume every day, but they do need consistency. Current volume profiles show rising participation without the kind of vertical spikes that often accompany exhaustion. Derivatives data also supports this view. Funding rates remain neutral to slightly positive, and there's no sign yet of the leverage buildup that typically precedes sharp reversals. A sudden surge in funding rates or open interest far outpacing price would be a red flag. But we're not there yet. Now let's be very clear about what would break the bull case this week, because this is where discipline matters. There's also an important psychological layer to this move that doesn't show up on charts, but analysts pay close attention to it. Right now, sentiment is improving without becoming euphoric, and that's a rare and valuable combination. Social data shows that while optimism has increased, skepticism hasn't disappeared. You still see hesitation, caution, and plenty of people waiting for the real pullback. Historically, markets don't top when people are unsure, they top when people feel certain. The absence of certainty is, paradoxically, supportive. This is also reflected in retail behavior. We're not seeing the kind of explosive retail inflows, app store ranking spikes, or easy money narratives that typically accompany late-stage rallies. Instead, participation looks gradual. That matters because sustainable trends are built on acceptance, not excitement. Analysts often describe this phase as the disbelief to acceptance transition, where price moves higher, while many participants remain underallocated or cautious. That creates fuel for continuation, because every dip becomes an opportunity rather than a threat. Whale behavior reinforces this interpretation. Large holders are adding selectively rather than chasing. They're accumulating on pullbacks, not buying vertical candles. That's a key distinction. In prior tops, whale distribution tended to occur into strength, with large transfers back onto exchanges. Right now, exchange balances continue to decline, and accumulation metrics remain positive. That doesn't guarantee higher prices, but it aligns with a market that's being positioned into, not exited from. Put all of that together, controlled leverage, improving structure, cautious sentiment, and steady accumulation, and you get a market that's behaving like it's building, not finishing. That's why this week matters. It's the moment where the market has to prove whether it can sustain confidence without tipping into excess. A decisive rejection at key levels followed by aggressive, high-volume selling would be the first major warning sign. Not a slow drift, not a modest pullback, but a sharp move lower that slices through support and fails to find bids. The second warning sign would be Ethereum losing its footing quickly, especially if it breaks back below recent support and begins to underperform Bitcoin meaningfully. That would signal that broader risk appetite hasn't fully returned. The third would be leverage rushing back in too fast, funding rates spiking, social sentiment flipping to easy money, and open interest exploding in a matter of days. That combination almost always ends badly for late arrivals. Macro shifts also matter, even if they're not the headline driver today. Crypto is increasingly sensitive to liquidity expectations. Right now, easing inflation data, calmer central bank rhetoric, and global liquidity injections are supportive. Analysts like Arthur Hayes have argued that crypto tends to front-run these liquidity cycles, moving before equities fully price them in. A sudden hawkish surprise, unexpected inflation print, or sharp risk-off move in global markets wouldn't necessarily end the trend, but it would increase volatility and raise the bar for continuation. Here's the most important point to keep in mind. This move does not need to be perfect to remain bullish. Pullbacks are normal. Consolidation is normal. Even a mildly red week wouldn't automatically invalidate the bigger picture. What matters is whether the market absorbs stress or fractures under it. Right now, stress is being absorbed. That's why this is a test week, not a verdict. Professionals don't ask, how high can it go? They ask, is the market behaving like it wants to go higher? At the moment, the answer is yes. Cautiously, structurally, and without euphoria. That's often how real trends begin, not how they end. So the right approach this week isn't chasing green candles or panicking on red ones. It's watching reactions, watching structure, letting the market prove itself. If it passes this test, the path later in the year opens up. If it fails, it simply means more time is needed, not that the story is over. Drop your thoughts in the comments. Make sure you're in for the XRP giveaway, and let us know what you're watching this week. We'll keep tracking it. And as always, we'll see you at the top.